So in this portion of the class, we're going to get to the bottom of what the chart of accounts is, why it's important, how to make it work for you. And I'm joined in this with my little friend. He has nothing to do with the chart of accounts. He's just kind of passing through. And there he goes. So the chart of accounts in accounting is all about categorizing things. It's all about putting things in the appropriate bucket. And the deal with the chart of accounts, you want it to have enough detail so that you can keep track of the things that you need to keep track of, but you don't want it to have a lot of extra stuff. You want it to be simple, you want it to be effective, and you want it to be easy to use. So when we're talking about a chart of accounts in general, in old school accounting, there are 5 account types. And they are assets, liabilities, equity, revenue, and expenses. So those are kind of the 5 broad categories that we would use to categorize things prior to accounting software. Well, in accounting software, we have additional, let's call them sub-accounts of those 5 different accounts. And when we choose those account types in QuickBooks, it tells QuickBooks that we want to use this particular module within the software. So let's jump back into our sample company here, our Craig's Design and Landscaping Services. And we're going to come over here to Accounting, and we're going to go to Chart of Accounts. Alternatively, you could go up to your gear icon, go to All Lists, and get there that way, or you can go to your company and get to Chart of Accounts. Now, when QuickBooks walks you through the setup process, when you tell QuickBooks what industry your business is in, QuickBooks is going to automatically assign you a chart of accounts based on that industry. And what QuickBooks is doing is it's taking every possibility of an account that you might need, and it's putting it in your chart of accounts. So you could end up with 150 accounts right off the bat, and probably 100 of them you don't need. So what I want to help you to understand is what you do need and what you don't need, what you can get rid of. So we're going to go take a peek under the hood at our chart of accounts. So we can see here that this business is using 44 different accounts to keep track of their financial records, out of a possible 250 accounts that are available with this particular subscription plan. And then down here, it's going to list out all of the accounts that are being used by this company to track things. So we've got the account name. We have a cash account, but theirs is called checking. They have a savings account. It's also a cash account, but it's called savings. So this is the name of the account. The type of account comes back to those account types, the assets, liabilities, equity, revenue, expenses, plus the specialized QuickBooks accounts. So you can see here that checking has an account type of bank. So in old school accounting, this is an asset account, but in the software, we're going to assign it the type called bank. And this is a specific type of an account within QuickBooks that says to it, we want to hook this account up to our bank account so that it will feed in our transactions. And we also want to be able to look at a check register, and we want to be able to reconcile this account. So when you tell it it's a bank account, you are telling it that you want to access those features. The detail type is usually going to be assigned automatically. We're going to come back to the detail type in a minute. But over on the right-hand side, you can see you have a QuickBooks balance. This is the balance that your QuickBooks records show. So there's $1,201 in your checkbook in QuickBooks. Your bank balance is what's feeding in from the bank. So this is everything that you have put into the bank and everything that has cleared the bank coming out. So according to the bank, you have a negative $3,621.93. So the reason that those are going to be different is because there are checks out there that haven't cleared the bank yet, or you have a deposit that you've done in QuickBooks, but the bank doesn't have it yet. So from here, you can also view the register for this. You can edit the account, you can make it inactive, or you can run a report. So you can have as many bank accounts set up as you want to. And the way that QuickBooks will know that it is a bank account and you want to be able to track it with the bank and you want to be able to reconcile it, it's because of this type that you've chosen. The next type type we want to talk about is accounts receivable. So accounts receivable is an asset, but in QuickBooks, we want to call it specifically the account type accounts receivable, because what this does is it tells QuickBooks that we're going to want to do invoicing, we're going to want to receive payments from our customers against those invoices, and we're going to want to be able to run an accounts receivable aging report and statements and things like that. So when we call an accounts receivable as the account type, that's what we're telling QuickBooks. We want these particular features to be applied to this account. And then we have some other accounts that are set up as an account type of other current assets. So a current asset is going to be things like inventory, prepaid expenses, things that are going to be turned into cash pretty quickly. So current means it's within a year, but a lot of times current means it's going to happen within the next 30 days. So when we assign something as an other current asset, what we're telling QuickBooks is on our balance sheet where we have assets, liabilities, and equity, we want this to be grouped with other current assets. So when we go to our financial statements, when we look at a balance sheet, under that current asset section, it's going to show all of our bank accounts. It's going to show our accounts receivable, our inventory, our prepaid expenses. Those are all going to be grouped together. And that's part of how we do financial statement analysis. We want to be able to look at which of our assets are current assets, meaning they're going to be turned into cash or they're already cash. Now I want to talk about this account right here, this undeposited funds account. You may see it, depending on how your chart of accounts is set up, you may see this being called payments to deposit. It's going to be listed as an other current asset, but what's going on with undeposited funds is that you are collecting funds that you've received from your customers, and you're going to make one deposit with all of those funds. So for example, you get a stack of checks in the mail, you go in and you receive all of those checks. Rather than them going directly into your checking account register in QuickBooks, they're going to go into this holding account called undeposited funds. And then when you go to make a deposit, it's going to show all of those individual payments. When you make the deposit with those payments in it, it will take that group and make that deposit in your QuickBooks register as one amount that will match up with the amount that your bank is going to show. So when those two things meet up in the bank feed, you're going to see a deposit for $12,100 in QuickBooks and a deposit for $12,100 in your bank. It's going to go and match up magically. If you did those individually in QuickBooks, rather than using the undeposited funds feature, when that tries to feed through from your bank is going to show $12,100 deposit, and you're going to show all these individual amounts that you're then going to have to try to figure out what went into that deposit. So the undeposited funds thing is just a holding tank for when you want to make one deposit from multiple payments. The next section we're going to see here is fixed assets. So a fixed asset is something that a company owns that they're going to own long term, and it's not something that they're trying to sell to turn into cash like inventory. So a fixed asset is something that a company is going to use in order to make revenue. This company has a truck. It's a landscaping company. So yeah, they really need to have at least one truck in order to get to their job sites and haul all of their tools. So this isn't a fixed asset, a long-term asset. And when we apply this type, the fixed asset, what we're saying to QuickBooks is we want these fixed assets to be grouped together on the balance sheet so that we can see all of our long-term assets, our fixed assets. You also hear these called property, plant, and equipment assets. We want all of those grouped together so that we can see those. So we also have two other items that are sub-accounts of this fixed asset called truck. And that is depreciation and original cost. So I'm going to drop a video down below this that explains what depreciation is. But basically, as an asset ages, we have to recognize in accounting that this asset is eventually going to be used up and will need to be replaced. So as that value of the vehicle or the piece of equipment decreases, we capture that using something called depreciation. And when we record an asset in our books, we're going to record it at the cost that we paid for it, not at the market value or what it's worth now. We're going to record it as what we actually paid for it. So if we paid $40,000 for this truck, the original cost is going to be recorded as $40,000. And then from that, we'll be using this other accumulated depreciation account to keep track of the value as things decrease. The next section is liabilities. So we're moving away from our assets and into our liabilities section. So our first liability is accounts payable. And this is a liability account, but in QuickBooks we call it an accounts payable account type, because just like with accounts receivable, with accounts payable, we're telling QuickBooks we want to activate certain features. We want to be able to enter bills from our vendors. Maybe we want to be able to do purchase orders, and then we want to be able to receive inventory against the purchase orders or the bills. And we want to be able to run some accounts payable reports, like an accounts payable aging report. The next couple of accounts are credit card accounts. Now, a credit card is a liability account, but in QuickBooks, we're going to make it a special kind of an account called a credit card. And what that does is similar to what happens with our bank accounts. We're telling QuickBooks we want to be able to hook this up to our bank. So if we've got a MasterCard with a particular bank, we want to be able to hook that up so that we don't have to manually enter all of our transactions. We can feed them in from the bank. It's a huge, huge time saver. So in this case, we have two different credit card accounts. One is hooked up to the bank, and you can tell that because of this double arrow here. The other one is not hooked up to the bank. So maybe this is an inactive account. We can see it's got a zero balance, and maybe that's an account that needs to be made inactive, or maybe it's a new account. We've just set it up and we haven't hooked up the bank account yet. And then we get into a new section that is other current liabilities. So these would be things like payroll taxes that we've withheld from employees' checks. We're going to put that in current liabilities. It's something that we're going to have to pay out very quickly. Also in here you would find sales tax payable. So these are things that are meant to be paid within a year or less, and a lot of times it's 30 days, like with accounts payable. In the next section we've got long-term liabilities, and when we tell QuickBooks that this is the type long-term liability, then we are saying we want these long-term liabilities grouped together on our balance sheet. And again, this is something that's really helpful with financial statement analysis and understanding the health of your business. These next couple of accounts are equity accounts. So we've got assets, liabilities, now we're at equity. In this case, we have two equity accounts set up. And a company can have more than that, certainly, and usually would. So we've got a couple of things here. We've got an opening balance equity account, and we've got retained earnings. A retained earnings account is the accumulation of profits and losses over time. So every time a business has a profit, retained earnings increases. When a business has a loss, retained earnings decreases. So this is that accumulation of profits and losses. The opening balance equity account is a QuickBooks thing. There is not an opening balance equity account in old school accounting. And the purpose of this is for when you are setting up your account and you need to bring in existing balances. So let's say you're using another software or you're using a spreadsheet way of keeping track of your books. So you're going to take the balances from whatever method you're using and you're going to bring them into QuickBooks. As you bring those balances in, you're going to be using opening balance equity as kind of a clearing account. And when you're all done bringing in those new balances, then the balance in QuickBooks in opening equity is always going to be zero. And look what we got going on here. The balance is not zero. That tells me that there is a problem here. Something needs to be cleaned up. So the next section of our accounts is about income. Revenue. So QuickBooks refers to it as income, but you will often hear it called revenue. So the thing with income accounts is you can have however many income accounts you need to have. If you have too many, sometimes it really makes profit and loss statement, the income statement, a mess. But you can have as many income accounts or as few income accounts as makes sense for your business. Now let's talk about cost of goods sold. When you have a business where you're buying merchandise for resale, or you're building something like a house, or you have a factory where you're turning raw materials into a product, cost of goods sold is a special kind of an expense that is specifically for the materials and labor that you need for that transformation process. So it is an expense, but in QuickBooks, we're calling it cost of goods sold because this is going to put it in a different spot on our income statement. And then the next section is going to be expenses. And you're going to have a lot of expenses. There's always going to be a lot of expenses. But just like with income, you don't want to have so many expenses that you don't know where to put things or that you can't remember where they go. One of the things that you can do with your expenses, and I highly recommend that you do, is to group them in categories. So for example, we have automobile expenses here, and then there is a sub account, and you can tell it's a sub account because it's indented. So you can have a variety of different sub accounts here. So we might want to have an overall account called automobile expenses, and then a sub accounts called fuel expense, registration expense, car wash expense. So you can have those sub accounts that give you some detail, and that's going to help you to find things when you go to enter something, because if you start to type automobile in the account line, it will bring up those accounts. And then when those go over on your income statement, your profit and loss, it's going to group those categories together. Now down at the bottom of this whole list of chart of accounts, we've got some other income and other expense items. These are things that are not related to the day-to-day operating of the business. They are outside of that. And because they're outside of that, we want to drop those down on our income statement to a section that's below our net income, our profit line. Usually when we're talking about other income and other expense items, we're looking at interest that you're earning on a bank account or interest that you're paying. Those weird, unusual things, we want to drop those below that net income or profit line so that we can kind of keep those separate from the running of the business. Now, circling back to the detail type, I said we'd come back to it later, and here we are. So when you set up a new account, and let's look at that. So when we go into new account, it gives us the opportunity to choose what type of an account. Is it an income account? Is it an expense, a bank account, an asset, a credit card, a liability, an equity account? Let's set up a new bank account. So then we're going to say, let's save account under bank accounts. So this is a specific section of accounts. I'm going to say save it as a bank account. What tax form is this going to go on? Well, this is a checking account. So when we say checking account here under tax form section, this is the detail type. And let's call this First Bank. We don't really need to put a description in there, but if we wanted to put like the last 4 digits of the bank account number or something like that, we could do that. Right now we're going to ignore starting date and opening balance, so we're going to say save. So now we can see that this has shown up in our chart of accounts. We have First Bank, the type is bank account, and the detail type is checking. So whenever you set up a new account, it's going to ask you for that detail type. So usually when you're setting up your chart of accounts with QuickBooks and it automatically sets it up, it's going to automatically assign that detail type. And you really won't have to worry about it too much unless you're setting up a new account. When you're doing that, that's when it's helpful to have an understanding of those account types. And I'm going to put a resource with this particular video so that you've got a listing of what the different account types are and what the detail type should be. So just remember, with the chart of accounts, the idea is to get enough detail without it becoming overwhelming, and to have things categorized and organized in a way that makes it easy to find and access what you need when you're entering a transaction. So down below, I will also link my chart of accounts video and my understanding financial statements video so that you have an opportunity to watch those if you haven't watched them yet.